Look at your screen right now. If you're watching this live, you know exactly what I'm looking at. If you're watching this replay, let me paint the picture for you. At exactly 12:01 a.m. Eastern Time on January 1st, 2026, the global silver market didn't just break. It shattered into two completely different realities. And what I'm about to show you makes the GameStop squeeze look like a practice round. While your COMEX screen is showing silver at $72 per ounce, physical dealers in Tokyo and Dubai are selling the same metal for $130. That's not a typo. We're looking at an 80% premium for actual silver over the paper price. This has never happened before in modern financial history. But here's what makes this absolutely terrifying. The moment this disconnect started, China implemented a total export ban on refined silver. 70% of the world's silver supply just got cut off from Western markets. And the CME's response? They've raised margin requirements 3 times in 3 weeks, forcing mass liquidation of anyone betting on higher prices. This isn't market mechanics. This is a controlled demolition to save the banks from the biggest short squeeze in commodity history. And they're doing it while the mainstream media stays completely silent. If you think you understand what's happening in silver, you're about to find out you don't know the half of it. Let me show you the smoking gun that proves this entire situation was orchestrated. On January 1st, 2026, China didn't just restrict silver exports. They implemented a licensing system so restrictive that only large state-approved companies can now export refined silver. And here's the kicker. To qualify for a license, you need annual production capacity of at least 80 tons. That immediately disqualified hundreds of smaller exporters who have been supplying Western markets for decades. China controls between 60 and 70% of the world's refined silver supply. Think about that for a second. In one policy move, they just ring-fenced nearly 2/3 of global silver for domestic use. Tesla, Apple, every solar panel manufacturer, every semiconductor company, they all need silver. And China just told them, get in line behind our domestic industries. But here's what makes my blood run cold when I look at the data. While COMEX futures are trading at $72, the Shanghai Gold Exchange is showing premiums of $8 over spot. That's the market screaming that physical metal is trading at a completely different price than paper promises. In Dubai, dealers who can actually source inventory are charging $130. In Tokyo, the same story. This isn't a regional premium. This is a complete breakdown of the global pricing mechanism. And I'm watching this happen in real time. Physical silver has essentially disappeared from Western markets while the exchanges are still pretending everything is normal. The last 4 bullion dealers I called yesterday said the same thing. We're not quoting prices. Call us next week. Meanwhile, JP Morgan just took delivery of 8.1 million ounces from COMEX vaults on January 7th alone. That's 99% of all silver delivered that day. The same bank that paid a $920 million fine in 2020 for manipulating precious metals markets is now hoarding physical metal while retail investors are stuck holding paper contracts that may never deliver. This isn't market dynamics. This is a heist in broad daylight. You need to boost this video right now. I'm not asking politely anymore. I've been tracking the analytics on this channel for 3 years, and I can tell you with absolute certainty that YouTube is actively suppressing this content. In the first hour this video was live, it had 847 views and was climbing fast. Then something happened, and the view count flatlined. Comments stopped appearing in real time, and the video disappeared from search results for silver market news. This isn't paranoia. This is pattern recognition. Every time I cover precious metals manipulation, the same thing happens. The algorithm buries the content. Subscribers don't get notifications. The video gets demonetized within hours. They don't want retail investors to understand what is happening in the commodity markets because if people realize the scope of this fraud, there would be a run on every bullion dealer in the country. Think about it. JP Morgan, Goldman Sachs, and Citigroup all sit on the board of COMEX. These are the same institutions that are massively short silver and need low prices to survive. You think they want millions of people watching a video that exposes their manipulation? You think they want this information trending on the same platform where GameStop investors organized? The mainstream media has been completely silent about the biggest commodity market breakdown in modern history. CNBC hasn't mentioned it once. Bloomberg is running cover stories. Reuters buried it on page 6. But they can't control social media completely, not yet. So here's what we're going to do. You're going to smash that like button right now. Not later, not when the video ends. Right now, while you're thinking about it, we need to force this onto the trending page before they can completely throttle the algorithm. Hit the notification bell so you actually get alerts when I post. Share this video in every investment group, every Reddit forum, every Discord channel you're in, screenshot the key points, and post them on Twitter and Instagram. Because if we don't get this information out in the next 48 hours, before they spin the narrative, millions of people are going to wake up to a silver market that no longer functions. And they're going to be holding worthless paper while the people who saw this coming are sitting on physical metal that's worth multiples of what they paid. This is your moment to be part of the solution instead of part of the problem. Boost this video now. Let me walk you through exactly what happened in December, because the timing of these events is not a coincidence. This was a coordinated attack on the silver market, and I can prove it with timestamps. December 12th, 2025, 4:30 p.m. Eastern CME Group announces the first margin hike. Silver futures margins increased by 10%. The market shrugs it off. Silver is trading at $67 and climbing. December 26th, 2025, Boxing Day, when most traders are with family, CME drops a bombshell. But here's where it gets interesting. While retail traders are getting margin called out of their positions, something else is happening in the COMEX vaults. December 27th through December 30th, 60% of COMEX's registered silver inventory gets claimed for delivery. We're talking about 76 million ounces in 4 days. That's more silver than most countries mine in an entire year, and it's walking out the door while the CME is supposedly trying to calm volatility. December 30th, 2025, 6:45 p.m., third margin hike in 18 days. But this one's different. They announced that starting January 13th, silver margins will be calculated as 9% of contract value instead of fixed dollar amounts. When silver was $50, that would have been reasonable. At $72, you're talking about margin requirements that most retail traders simply cannot meet. January 1st, 2026, 12:01 a.m. Beijing time. China's export licensing system goes live. Hundreds of smaller silver refiners and exporters are immediately cut off from Western markets. The global silver supply chain fractures overnight. January 2nd, 2026. Physical silver premiums in Shanghai hit $8 over COMEX spot. Dubai dealers start quoting $120, $130 for silver bars when they can source them at all. January 7th, 2026. Here's the smoking gun. JP Morgan takes delivery of 8.1 million ounces from COMEX vaults. That's 99% of all silver delivered that day. The same bank that the CFTC fined $920 million for spoofing precious metals markets is now hoarding physical silver while retail investors hold paper contracts. And January 8th, 2026, CME issues new margin requirements for dozens of silver contract combinations. I'm looking at the official notice right now. It's 47 pages long. They're not just raising margins. They're making it mathematically impossible for smaller traders to participate in the silver market. This isn't market volatility management. This is systematic exclusion. They're clearing the field of retail participants, while institutions accumulate physical metal at artificially suppressed paper prices. The timeline proves coordination. The margin hikes weren't random. The vault drainage wasn't coincidental. And China's export ban wasn't market timing. This was planned. This isn't the first time they've done this, and the playbook they're using right now is identical to what they did in 1980 and 2011. The only difference is the stakes are exponentially higher. Let me take you back to March 1980. The Hunt brothers had accumulated 100 million ounces of physical silver, not paper contracts, not ETF shares, physical metal sitting in warehouses they controlled. Silver went from $6 to $50 per ounce in less than 18 months. The exchanges panicked. On January 7th, 1980, they implemented something called Silver Rule 7, which banned all new long positions. Think about that. They changed the rules mid-game to make it illegal to bet on higher silver prices. You could only sell. Then they raised margin requirements 5 times in 3 weeks. Sound familiar? The Hunt brothers were facing margin calls of $100 million per day. They couldn't post the collateral. The banks refused to lend. And on March 27th, 1980, a day known as Silver Thursday, the price crashed from 21 to 10 in a single trading session. The Hunts were bankrupted. And who stepped in to buy silver at $10? The same banks that had refused to lend them money at $20. But here's the key difference. In 1980, the Hunt brothers were trying to corner the market through speculation. What's happening now is industrial users desperate for physical metal because supply chains are breaking down. Fast forward to 2011. Silver hit $49 per ounce on April 25th. Physical demand was exploding. Coin dealers couldn't keep inventory. The U.S. Mint suspended Silver Eagle production due to lack of blanks. What did COMEX do? Between April the 26th and May 5th, 9 trading days, they raised silver margin requirements 5 times, from $5,000 per contract to $21,000 per contract, a 320% increase in 9 days. The price collapsed from $49 to $26 in a week, not because demand dried up, not because new supply was found, because they made it mathematically impossible for leveraged traders to hold positions. And who made money on that crash? The same banks that were massively short silver and couldn't deliver physical metal. But 2026 is different. In 1980, silver was primarily a monetary metal. Industrial demand was minimal. In 2011, industrial demand was growing, but not critical to major industries. Today, silver is absolutely essential to the global economy. You cannot make semiconductors without it. You cannot build electric vehicles without it. You cannot manufacture solar panels without it. And with AI data centers consuming massive amounts of electricity, the demand for silver and power infrastructure is exploding. China isn't trying to corner the silver market for speculation. They're securing industrial inputs for their domestic economy when they cut off 70% of global refined silver supply. They're not playing financial games. They're preparing for a post-dollar world where commodity resources determine economic power. The Hunt brothers were fighting banks. China is fighting the entire Western financial system. And this time, the physical shortage is real. The industrial demand is non-negotiable. And the institutions trying to manipulate the price are sitting on short positions that are multiples larger than what bankrupted the Hunts. JP Morgan alone is short 95 million ounces of silver. Goldman Sachs is short 67 million ounces. In 1980, 100 million ounces was enough to move the market. Today, these two banks are short 162 million ounces, while sitting on COMEX boards that decide margin requirements. Same playbook, bigger stakes. And this time, the manipulators might be the ones who get cornered. Now let me show you the numbers that prove this entire system is built on a lie. And I'm going to use COMEX's own data to expose the fraud. COMEX silver inventory is divided into two categories, eligible and registered. Eligible means the silver is sitting in approved warehouses but isn't available for futures delivery. Think of it as storage space that the exchange has no control over. Registered means the silver is specifically allocated to satisfy futures contract deliveries. As of January 8th, 2026, total COMEX silver inventory is 312 million ounces. But here's the critical breakdown. Only 127 million ounces are registered. That's the silver that can actually be delivered against futures contracts. But wait, it gets worse. The open interest on silver futures, that's the number of contracts that exist and could demand delivery, represents 935 million ounces of silver. Let me say that again. There are paper claims on 935 million ounces of silver, backed by 127 million ounces of physical metal. That's a 7.4 to 1 ratio. For every ounce of actual silver in the vault, there are 7 pieces of paper claiming ownership of that same ounce. This is fractional reserve banking applied to precious metals. And it only works as long as nobody actually asks for their metal. But here's what's been happening since December. The registered category has been getting drained at an unprecedented rate. In the last 6 weeks, 76 million ounces moved out of registered inventory. Some went to eligible status, meaning people took ownership but left it in the vault. But a massive amount left the COMEX system entirely. Let me put this in perspective. JP Morgan's vault alone holds 140 million ounces of eligible silver. But that doesn't mean JP Morgan will make it available for delivery. That's their metal. They're using COMEX warehouses for storage, not for backing futures contracts. The same is true for all the major banks. They are storing their physical silver in COMEX facilities while selling paper contracts backed by a shrinking pile of registered metal. And here's the mathematical impossibility. If just 15% of silver futures holders demand physical delivery instead of cash settlement, the entire registered inventory gets wiped out. Not 50%, not 30%, just 15%. We're already seeing this happen in real time. January open interest for silver, which is supposed to be a minor delivery month, is at record highs. Normally, traders roll their positions forward to avoid delivery, but not this time. They want the metal. And the exchanges know they can't deliver. That's why they're raising margins to force out retail participants. That's why China cut off exports. That's why physical premiums in Shanghai and Dubai are exploding. The vault mathematics don't work. They never worked. The system was designed to function on the assumption that paper and physical are equivalent. But when industrial users in China, India, and the Middle East start demanding actual delivery, the illusion collapses. Here's the really terrifying part. Those 127 million ounces of registered silver, a huge portion of that is already spoken for by ETFs like SLV. The amount of silver that could actually be pulled from the system for new delivery demands might be as low as 50 million ounces. 50 million ounces against 935 million ounces of paper claims. That's an 18.7 to 1 ratio. The mathematics are impossible. The system is insolvent. And the only reason it hasn't collapsed yet is because most people still believe their paper contracts are as good as physical metal. But that belief is starting to crack. And when it breaks completely, 127 million ounces becomes zero very quickly. Now let me explain the legal weapon they have in their back pocket and why it should terrify anyone holding paper-silver contracts. Hidden in every COMEX futures contract is a clause called force majeure. It's French for superior force, and in contract law, it means an unforeseeable circumstance that prevents someone from fulfilling their obligations. Natural disasters, wars, acts of God. But here's where the legal fraud happens. Read that phrase again. In its sole discretion. They don't have to prove force majeure to an independent court. They don't have to meet objective legal standards. They determine it themselves. And their decision is final. So when COMEX can't deliver silver because they have sold 935 million ounces of paper backed by 127 million ounces of metal, they can simply declare force majeure and settle your contracts in cash, not at the market price, not at the price you were expecting when you bought the contract. At whatever price the exchange decides is fair. And here's the smoking gun that proves this is all coordinated. Let me read you the current COMEX board of directors. 3 executives from JP Morgan, 2 from Goldman Sachs, 1 from Citigroup. The same banks that are massively short silver are sitting on the board of the exchange that decides when to declare force majeure. The same institutions that owe 162 million ounces of silver they don't have are the ones who get to decide whether market conditions constitute an emergency that justifies cash settlement. This isn't market regulation. This is institutionalized conflict of interest. Let me show you exactly how this plays out. When silver was trying to find its real price in late December, when physical demand was overwhelming paper supply, what happened? The exchanges didn't let the market clear. They didn't allow price discovery. They raised margins to force liquidation of long positions, while declaring the price movement disorderly. But whose positions were they protecting? The shorts, the banks, the same institutions that sit on their boards. In a free market, if you can't deliver what you promised, you get liquidated. You face unlimited losses until you can source the commodity or go bankrupt trying. But when you control the exchange, you can change the rules. They can declare that the China export ban constitutes force majeure. They can claim that industrial demand represents market manipulation. They can argue that any price above $75 represents disorderly conditions that threaten market integrity. And the precedent is already set. In March 2022, the London Metal Exchange canceled billions of dollars of legitimate nickel trades because they would have bankrupted a major participant. They literally erased winning trades from existence to save a short seller. The LME's excuse? Force majeure. Unprecedented market conditions, orderly market function. All corporate language that translates to, we changed the rules because our friends were losing. Now they're setting up to do the same thing with silver. But this time, the stakes are exponentially higher. Nickel was a single company facing bankruptcy. Silver involves the entire fractional reserve system of precious metals. If COMEX declares force majeure and settles silver contracts in cash, it's not just market manipulation. It's the admission that the paper precious metals market is a fraud. It's the confirmation that your futures contracts are not claims on actual metal. They're options held by the exchange to deliver or not deliver based on their discretion. And that discretion will always favor the institutions that control the exchange. The moment the free market threatens to destroy their short positions, they invoke superior force and rewrite the contracts. The House always wins because the House controls the rule book. And when the rules don't work anymore, they change them.